So the kind of three buckets that I would, tend to talk about with clients, and maybe not number one, but number one for a lot of people is pensions. So just to cover a few basics, it's really about saving tax now and saving money for your future. The state pension age is going, well, it's increased in recent years, and who knows what it'll do in future. But by the time most people get to state pension age, I think that's later than they would like to be retiring. So, they need some sort of private provision for whether that's the time between, hanging up the boots at 55, 60 or 50 or whenever it is, and that state pension for them and maybe their spouse. So, you need a personal pension. You're saving tax now. Some people will be on thresholds of earnings just above 50k for child benefit starts to get taken away, and above 100k, you start to lose your personal allowance, which is the element of tax-free income. So there's a couple of thresholds that people are worth being aware of, and a great top tip there of making pension contributions effectively reduces your income for those measures. So if you're earning 105,000, bringing your income to below 100,000 by using pension contributions just minimises your tax. At that rate, by the way, of the earnings, you're effectively paying a 60% tax on some of your earnings, which is not something anyone wants to do. So, use pension contributions to your advantage. The personal allowance and income tax thresholds have been frozen by the Chancellor for 5 years. So it's, if you get a pay rise, you're effectively paying more tax for the next 5 years. So just think about your pension contributions. For some people who are perhaps higher earners, you can make quite a lot of pension contributions as a value, potentially going back 3 tax years. So people tend to think of pensions as something that's, they don't need to worry about for a long time. My suggestion is you pay attention to them now, look at what's going on, use them to your advantage from a tax perspective. It's not all about tax, but if you can save some tax and help your future self, then what's not to like about that? There are also inheritance tax, which some people care about, some people don't. Pensions are effectively outside of that for inheritance tax. So they're a very good, sort of planning tool as well for giving legacy amounts to whoever you want. ISAs are the second one, so individual savings accounts. They are a use it or lose it. So if you don't make any contributions in a given tax year, you can't go back, whereas pensions you potentially can. So I guess my point is, even if interest rates at the moment are pitiful and will probably be low for some time, don't think that you shouldn't be putting money into ISAs. Cash ISAs are probably where, I don't know what percentage but of the UK's savings are in, but cash ISAs are generally quite popular despite the interest rates. Stocks and shares ISAs are also good for the future, and depending on what you want your money for, of course. There's a lifetime ISA, so if you're under 40, get applying, get a lifetime ISA. There's a few rules and stuff which I can talk about whenever with people, but you have to open them before you're 40. But the point is with ISAs, get some money in, even if it's in cash, but at least it's within that tax wrapper, such that as and when rates pick up or you invest it and you get some growth, it's completely tax-free. You could use your ISAs, when you're older, to generate a tax-free income. It's a really good planning method to supplement your income when you're older, or any time for that matter, but particularly when you're older and you want some extra income or some money to go and pay for that cruise, then you can just take it out. There's no issue, no tax, and hopefully over the years you'll see some growth. And then the sort of final little third, I suppose, bucket, and it's I alluded to earlier about people coming into money, whether that's, say, a business sale or inheritance or some shares perhaps they've sold. A general investment account utilizes some additional allowances you have, such as capital gains tax allowance and dividend allowances. So a general investment account allows you to invest in the stock market and hopefully make some money over time using some tax allowances. So I guess my general point is you have sort of 3 buckets there. They're simple. Everyone can do them. Everyone can open them. Everyone can use them. Even children, they can all have all these accounts as well. You have allowances, tax allowances. Use them. Don't Don't just get into the next year and think, I'll do it then. Have a look, pay attention, and get some money into them if you can. Don't need to go too crazy with speculative investments or cryptos, or, we get asked all the time, or even property. Why, just think of, can I sell that brick or a brick of a property investment in a few years? No, you can't, or not very easily, rather. So use these simple vehicles now and make the most of them. And then hopefully in 5, 10, 20, 30, 40 years, you'll look back and be very grateful to your younger self.